In this video, we are going to look at how a company establishes a sales price for internal sales. Now, picture a vertically integrated company, one that has a number of different divisions. And these divisions normally transfer goods or services to other divisions within the same company, as well as to people outside the company. Now, the price used to record the transfer between the two divisions is called a transfer price. And so this section is called transfer pricing. How do I establish that? Well, there are usually three ways to determine the transfer price. One, negotiated transfer pricing. That is, a demand is through agreement between the two managers involved using the negotiating transfer pricing approach. A minimum transfer price is established by the selling division, and we will look at an example of that, and the maximum by the purchasing division. Another way is the cost-based pricing. That is, we transfer at what it costs the division plus a markup. And a third way is if we have an outside market-based price for this product, then if we transfer it internally, we use the market-based price as the base for determining what the transfer price is. Now, conceptually, we want to encourage division managers to be autonomous, that is, operate on their own. And so negotiated transfer pricing is the best, but it also causes a heck of a lot of problems. Let's begin by taking an example. The Alberta company makes rubber soles for working and hiking boots. There are two divisions. There's a division that makes the sole, and they can sell outside. And then there's the boot division, which makes leather uppers for hiking boots that are attached to purchase soles. Division managers are compensated on profitability of their division. And management now wants the sole division to provide at least some soles to the boot division. Here's the situation in terms of the financial statement of both. The boot division has a selling price of $90 to the outside world and the variable cost of $35, and it purchases the soles for $17, so they have a contribution margin of $38. The sole division, they can sell to the outside world at $18. They have a variable cost per sole of $11, so they have a contribution margin of $7. Together, they have $45 contribution margin to the fixed cost of the company as a whole. Now, what would be a fair transfer pricing if the sole division had to sell $10,000 to the boots division? Well, if the sole division sells to the boot, the payment must at least cover its variable cost plus its lost contribution margin per sole, because keep in mind it's selling to the outside world at $18 and it costs them $11. The minimum transfer price then would be the variable cost plus the opportunity cost from selling to the outside world. So they would transfer to the boot at $18. But the boot division is paying $17 to the outside. They're buying it from the outside world at $17. So there would be no deal. The manager of the boot division says, hey, I'm not going to pay more than $17. The manager of the sole division says, well, look, I am getting $18 for my soles now, selling to the outside. So we have no deal. However, if the sole division had excess capacity, that is, it can sell the $70,000 to the outside world, but it can produce $80,000. So it has the available capacity to produce those extra 10,000 soles. And they can't sell them to the outside world. They can only sell them to the boot. So therefore, the contribution margin is lost. And therefore, the minimum price would be the variable cost. So the situation is now that I will pay no more than $17, says the boot division. And the sole division says, I want at least $11, so somewhere between $17 and $11 would be something like the transfer price if they both can agree on it. So that's the situation. Each manager wants to maximize the profit, but you've got to protect to make sure that they don't make decisions that is to the detriment of the company as a whole. So with excess capacity, the minimum transfer price is the variable cost of the unit sold internally. It may differ for units sold internally versus externally, but we can still use that as part of the formula. Using costs incurred by the division producing the goods as its foundation, we're going to look at cost-based transfer pricing here. And maybe based on the variable cost alone or the variable cost plus the fixed costs. So what happens here is the selling division adds a markup to the costs that it incurred in producing the product if it has to transfer. But this can result in dysfunctional behavior. For example, our Alberta company requires division to use transfer pricing based on variable costs. So if I can cost of the sold purchased from the sold division is 11, then the contribution margin here is 44 for this 10,000. But the sold division, because they're transferring at the variable cost, is earning no contribution margin, so the total contribution margin has gone down for the company from 45 to 44. With cost-based pricing is a bad deal for the sold division. No profit on the transfer of 10,000 souls to the boot, and they lose the 70,000 that they would have sold to the outside world. The boot division's happy. It increases their contribution margin by $6 per soul. If the sold division has excess capacity, the division reports a zero profit on these 10,000 units. The boot division gains $6. So overall, the company is worse off by 60,000. And that's great for the boot division, but it's not great for the sold division. And this does not reflect the division's true profitability because this guy had to transfer at his variable costs. Now, the last thing is market-based transfer pricing. If we have an existing market price for these competitive goods, then we could say, look, we could sell it to the outside world for this amount, so if I have to transfer it to you internally, then I want at least that amount. But this can lead to bad decisions if we have excess capacity. That's assuming, you see, we could sell to the outside world. If we have excess capacity, then we can also produce internally, and therefore the market-based price would not be a factor. Also, it's very difficult to come up with a well-defined market price. That market price includes transportation, includes marketing, includes a number of different things. It serves as a base to begin negotiations, but there are many problems with it. So the best thing, again, is negotiated transfer pricing. And this is all in order to encourage managers to act in an autonomous way, running their division as if it were a business, and have an artificial price for the goods that are transferred into their division. Now, if we're talking about a company, an integrated company, with divisions in different countries, and the goods are transferred from one country to another, then this whole thing becomes a whole different ballgame because of the globalization of operations. And most of the trade between companies is transferred between the divisions. What we want to do for the company is maximize the after-tax profit. So therefore, if we're transferring from one company or one country that has a tax rate of 35% to another country that has a tax rate of 10%, then we want most of the profits to be in this company, in this country, and in that way pay a lower tax. So transfer pricing is a big issue for multinational companies. Governments are watching this. They want to make sure that there's a fair transfer price, especially when a company is transferring products from a high tax country to a low tax country. But that's the way the world works today in a globalized business of operations. So transfer pricing is a whole course on its own. There are many behavioral aspects to it, many problems with it, but nevertheless, it's a fact of business life today.